Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings on Seeking Alpha. I've had a subscriber ask me to cover a stock that is very, very popular right now, and I can tell you I've been in the securities business for 50 years, and I've talked to hundreds, if not thousands of investors over those years, and one of the hardest jobs I've ever had in doing that was trying to convince an investor that one of their most favorite or popular stocks was overvalued. Well, that's what I'm dealing with today. I'm going to be talking about Tesla. I love the company. I think it makes one of the most exciting automobiles I've ever had the experience to drive. I think the company is going to do great things in the future, but I also believe that the market is currently valuing it at an insanely high valuation. Therefore, I do believe there's a lot of danger in the stock. And what I'm really trying to suggest here is I'd love to own this stock if I could buy it at an attractive valuation that at least made some economic sense relative to fundamentals. But again, what I want to do is build my case by going through the numbers. So let's go ahead and take a look at Tesla by the numbers here, utilizing the FastGraphs Fundamentals Analyzer software tool. To start, I want to start out with adjusted operating earnings and kind of look at Tesla in relationship to this very, very important fundamental. It's a fundamental that most companies, their price will track their operating earnings line, which is the orange line on the graph. But what I want you to notice here with Tesla is that they went public in June of 2010. So we're really we're just, past their 10th anniversary as a publicly traded company. And I do want you to notice a couple of things here. Number one is, when I look at the stock price in June, it came out at, it was split adjusted 477. It got up to 7, it got up to 10, it doubled at one point, but it traded within this range for the first, 2 or 3 years. Then we had this big surge in price that happened in 2013, and then the stock was trading in the 40s. And I want you to notice as I go across here, 40 and 50, even down into 38, 42. These were normal valuations, mid-50s here for Tesla, until we actually came to what I'll call the midsummer of 2019. Here I'm hitting May of 2019. So if I click there, assuming I made a $10,000 investment at $37 a share, which was on the low side of its historical average over the last 5 or 6 years, and held it through yesterday's close, the stock would today be trading at $604.48 yesterday's close. That's a 1,500% increase. That's an annualized rate of return of over 500%. But keep in mind, I'm only measuring approximately a year and a half here. So this stock has had a tremendous run, and it's far inconsistent with what its historical run has been. But let's take price off the graph for a moment, and let's look at just the business behind the stock. Now, we got some interesting numbers here as well. What I want you to notice is, they had a loss in 2010, a loss in 11, a loss in 2012, eked out a small profit in 2013, then it went back to a very small, really small profit in 2014. Then they lost money for several years, barely eked out a profit in 2019. But then they did make $2.34 a share. They're estimated to make $2.34 a share. Now that's a 38,900% increase over what they earned last year. That's an anomalous number. Okay, so we're drawing this graph here with a PE ratio of 15. I want to make that clear because that's kind of a normal, PE ratio. So when I bring the monthly closing stock prices like we saw, we've got this PE ratio of 15, which may be understating the company's value. And I'll show you what I mean here. But then we've got the stock trading at a blended PE ratio of 275, we'll call it, which is extremely high. That's an earnings yield of only 0.36%. Okay, that's a third of 1%. I want to be clear. In other words, if you owned the stock and they paid you 100% of all their profits, that would only represent a 0.3% return at today's valuation. Okay, so the stock is clearly overvalued. Now, I do want to do something. I want to use the scroll feature here. I want to move this into alignment to where just before the company started making a profit. Now, I have 100%, 38,000%, 57%, 37%. So I'm starting to get a different picture. If I move this scroll bar over just one more here, now all of a sudden you see that the growth rate is 842%. But that's an average of 38,000, 57, and 37. So I'm drawing this PE ratio here at equal to the growth rate at a PE of 842. But that's really a radical number. Let me draw a PE ratio that would be more equal to what I would call its consistent growth rate. Now, if I shorten this time frame again, now I've got a growth rate of 46%, okay, 46.57. So let me add that to the previous graph, because that's really what I would call the true growth rate, throwing away this anomalous number, which, by the way, as I mentioned in the written portion of this presentation, they've never really made any money on their automobiles. I'll talk about that a little bit more. But let's go ahead and draw that. I'm just going to draw a 46 PE ratio on the graph. So now what you see is I've got this PE ratio that's really equal to what I would call a more true version of their current growth of 46 here. And again, the stock is trading at this 274.8 blended PE. That's really crazy. That's a really crazy high valuation. Of course, that becomes more stark when I bring this thing back, to where it would be more normalized. Now, when I look at forecasting, estimates going forward are for Tesla to grow earnings at 29%. That's a very, very high number. There's your 46 PE, okay? And then the orange line would be your PE of 29.32, or P equals to the growth rate, PE equal to the growth rate. Those measures make Tesla extremely expensive. By next year, if the stock were to revert to a mean valuation, we're talking about going down to 29 times earnings, that would be a $97 stock. That's analogous to what J.P. Morgan was saying and what I talked about in a recent announcement. They raised the valuation of Tesla from 80 to 90, and this is 97. So these numbers are always ish, by the way. There's no one has a clear look at the future. But the bottom line is, no matter how you measure it, Tesla is a very, very pricey stock today. So let's look at some other metrics. A favorite of mine is operating cash flow, okay? Because as I said, earnings are optional, but cash is cash. All right, cash is something you count, earnings are something you can manipulate. Bottom line is, again, we see no operating cash flow generation to speak of up through 2017. Then we see this huge spike, just like we saw with earnings, slightly different number. And then we've seen these really nice 10% and 60% cash flow growth here, followed by estimate for 51, and then dropping off to 5% going forward. So again, if I measure this stock based on operating cash flow, and I bring it into here where I have a little more of a realistic number, I once again get a number very close to that 90 to 100, 98. The last time I showed you 97. Again, these numbers are never perfect. They're not meant to be calculated as perfect. They're approximately what this company will be worth, and that's giving it a multiple of 15 times operating cash flow, which would be relatively normal for most companies. So then the next thing we want to look at, let's go ahead and look at EBITDA, which is earnings before interest, taxes, depreciation, and amortization, because that's another kind of cash flow oriented number, if you will. In other words, it is an earnings metric, but it's an earnings metric before a lot of the accounting adjustment. So let's look at Tesla based on the EBITDA. Now here we see a graph that looks like the price is justified, but the reality of it is what you have here is a normal price to EBITDA of about 185. If I change this time frame a little bit and go back here to more normal times, you'll see, as I did in the written portion of the article, the normal price to EBITDA would have been actually a lot lower. I'm sorry, I didn't go back far enough. Okay, the thing I'm trying to get across here, and I'm not doing it very well here, the thing I'm trying to get across is this line is being drawn at a 490 price to EBITDA. That's a crazy number, but even at that number, Tesla would look like it's overpriced. If I go to forecasting, earnings is estimated to grow at 27%, but I've got this normal price to EBITDA here at about 185. So what I'm really trying to tell you or share with you here is that because we've had such a big jump in earnings and cash flow and EBITDA in the year, that got the stock irrationally exuberant, but that's an unsustainable number. So let's look a little deeper at the company, and let's look at some other aspects of Tesla that I talked about in the written portion of the article. First thing I want to talk about, let's go ahead and go into the balance sheet, and let's look at cash, okay? One of the things that Tesla has, they have a lot of cash, and I'm going to get into gross cash in a moment. They have $7.36 a share in cash, but keep in mind that is really anemic, if you will, if you compare that to their price, current price, yesterday's price of over $400 a share. So they have cash and they've generated a lot of cash. When you look at it in gross numbers, it's even more impressive. The company has $6.5 billion in cash. That's through the end of 2019. If I look at what happened since then, if I go look at the subsequent quarters, the cash went to $6.5 billion, to $8 billion, to $8.8 billion, and then through the September quarter, $14.7 billion. Now, the next question would be, where in the heck are they getting all this cash? Well, the obvious answer to that is, if I go into the income statement here and look at common shares outstanding, what I want you to see, and I want to go to yearly, I want you to see that Tesla's been issuing shares every year. Okay, last year, they grew their share count from 853 million to 885. If I look at the most current quarterly rates, the number through the September quarter, they have 948 million. You multiply that by their share count, remember that's raising shares, they're raising an awful lot of money and raising an awful lot of cash. So, the company is definitely cash rich and they definitely have a lot of assets. But I do want to remind you that they've been raising this cash at these extremely high multiples. In other words, they've been selling into this very, very inflated market. Now, by the way, I'm not denying that this happened. This has happened to a lot of stocks and is happening today to a lot of stocks, especially in the technology sector. Some of the hot stocks, the Apples, the Microsofts, the Netflix, etc. But the point is, in the long run, fundamentals rule. In the short run, you can have these crazy numbers. This stock just this year, if you look at it just from, basically 2020, there's December 31st, 2019, to yesterday's close, the stock was up over 600%. That's tremendous performance, but if it's only worth $90 a share, you've got this 80-some% potential loss that could happen. Now, the other thing that I talked about, the company has made a significant amount of money through selling these credits, these energy credits that they've been selling to other manufacturers. So, the company is not making money selling cars right now. They're making their money selling these zero emission credits, and that's great while that party lasts, but at some point this company does have to start making money, in my opinion. They have to start making money selling their cars. They have other businesses that are attractive, and have good long-term growth potential, and I'm definitely into that. But right now they're not making any money. Their gross margins are actually pretty high across the board for the company. So they are generating some gross margin, but watch when I do net margins. They literally have no net margin. And again, the only reason they would have shown a loss last year if they weren't selling those emission credits. Plus they're diluting the shares. Now, as an existing shareholder, that means my percentage ownership keeps getting smaller and smaller and smaller. However, that's not necessarily all that bad if the company's stock price keeps going up. But you got to be careful you're not playing the greater fool. At some point, you would have to logically assume that Tesla is going to sell at a normal valuation. So let's look at some of their competitors here, if you will. In other words, what I'm showing you here are simply other automobile manufacturers. Here's Subaru. Trades at a blended PE of 15. It has, obviously very spotty earnings. One thing I want you to notice about these automobile manufacturers, it's very, very difficult to make money in automotive. Here's General Motors that came out of bankruptcy, as you probably all know. I'll get rid of that anomalous number so you can see it a little bit clearer here. The reality of it is it's very hard to make money selling automobiles, and frankly, Tesla isn't doing that just yet. Now, I think they will someday, but they're not there yet. I do believe their business is going to grow, but it's still not there yet. Here's Ford. Ford hasn't made anybody any money in 20 years. We just keep going on. This is another quote-unquote green energy manufacturer. It's got a very, very high multiple, even though the company makes no money. So the ones that are green are looking like Tesla, but the point is that a sustainable price? If you buy the stock today, are you going to continue to see those lofty valuations, or are you going to eventually see blended PE ratios in the 12 and 15 range, as most other auto manufacturer trades at? Here's BMW, again, a 13 times earnings stock. So, there's an awful lot of really high valuations in some of these sectors, but for the most part, automobile manufacturers aren't making money and they're trading at relatively low valuations. I love Tesla. I want to double, state that. When I drove the Tesla Model S, I had the most exhilarating experience in an automobile I've ever had. It was just unbelievable. Its acceleration is incomparable, and I've driven a lot of big, powerful V8s, cars by BMW, General Motors, etc. Never experienced anything like the Tesla. Great company, great car. I'm a major admirer of Elon Musk. I just think he's a genius. I think he's a major risk taker, a great entrepreneur. He's also got some quirks, and I'll admit that. But the bottom line is he's done a great job with his company. He builds a great automobile. The market is given him and his company and his great cars a lot higher valuation than I think the company actually deserves in the long run. So if you own the stock, I just think you need to be careful. When you can, you might want to take a little money off of the table. I just really believe that the stock is trading at such a high valuation right now that at some time in the future, that could be a week from now, a month from now, a year from now, or even 2 or 3 years from now, because sometimes these valuations can run a long time, but it doesn't take a lot of bad news for a stock at these kind of valuations to eventually have something. We saw that. Now this was COVID, where the stock got hurt, and then of course it's recovered and rallied to all-time highs again. It was trading at a much higher, at over 654th this year. It's already down 50 points from its all-time high for the year. There's obviously a lot of risk. A lot of other companies are getting into the electric car business. I think Tesla in some ways is going to profit from that, but love the company, love the cars. I think the stock is really scary. So you want to pay attention to the valuation. Someday I'd like to buy the stock and be a long-term owner of this stock, but that isn't today. Anyway, I hope you enjoyed this article. Hope you don't shoot the messenger. Tesla's a great company, a very expensive stock. If you like what you saw here, don't forget to give me a like, ring the bell, and subscribe to our YouTube channel. We appreciate it. Thanks for watching.